Say imagination. Baby nigga and
Yo, what is going on, family? What is going on? What is going on? What is going on? I hope everyone is healthy, wealthy, and amazing. Guys, we're going to get started in literally just a few minutes' time. I want you guys to go back to your group chats and spam this link. Let's max this out. 12 spaces left, and we'll get started when we hit 100 participants. See you in a minute.
it do not matter. Turn to a savage, pocket got fatter. She call me daddy. Smoking that gas, going out that Zany. She on a powder. Nowadays I am on my head, I got sadder. Money got longer, speaker got louder, car got faster. Turn to a savage, pocket got fatter. She call me daddy. Smoking that gas, going out that Zany. She on a powder. Nowadays I am on my head, I got sadder. Money got longer, speaker got louder, car got faster. hustle. Money so old, dollar spoiled. Yeah, my little so spoiled. Yeah, I rub her down in oil. Yeah, I got money now, you know it. Yeah, diamonds on my tooth. Yeah.
Okay. You know what? Yeah, I see the time, man. I ain't got time to wait for laggers. So, guys, look. First things first, I want to welcome every single one of you guys to tonight's call. If you guys can hear me, if you can see me, if you're excited to learn how to get some mega risk reward trades, let me get some 111, some 777s in the chat. Let's see if y'all can hear me. Okay. Sheesh. Let me see your cameras on as well. I want to see your guys' faces. I would like to see who I'm talking to. It's about to be lit. So, guys, who we're going to be starting off with today is one of my students. You see, this is someone who has come in and achieved some immense success. He actually managed to completely retire himself at 18 years of age after just 3.5 months of being in this academy. So what I'm going to do is I'm going to pass it over to Mr. Ryan Walton to give you guys an introduction to smart money, some basic concepts, and then we're going to get into some of the mega risk reward trades after he finishes. So if you're excited to hear from Ryan, let me get a 777 in the chat because I know I'm super excited, bro. Ryan, are you here?
I'm always here, bro. Always locked in, man. I appreciate you. Such a legend, bro. Once again, I just want to give it back to Kieran. The guy's a legend. He's helped me so much. And I know he's helped everyone else on this call as well. So drop some more 777s in the chat if Kieran's ever helped you on your trading journey. I expect to see a lot, right? So with that being said, I appreciate you for the edification, Kieran. I just want to come on here quickly because I know that personally, I know a lot of people on this call that are new to smart money concepts and don't have that much advanced knowledge on smart money concepts. So I want to sort of do a short breakdown on what they are and why we use them before Kieran goes ahead. And I know the trades that he's going to get into are going to be saucy. So with that being said, let me go ahead and share my screen, right? Just so like I said, I can give everyone a brief understanding of what they are and why we use them. So smart money concepts, right, is the way that we trade for those people that don't know. So it's how we're catching these 1 to 100s, 1 to 50s, 1 to 20 risk rewards, right? These huge trades that everyone wants to catch, right? Now, what is smart money? You see, let's have a look, right? The people who control the foreign exchange markets, right? The people who have the most market share are who, right? Largest Forex participants, the banks, right? JP Morgan, Deutsche Bank, Barclays, right? Banks and hedge funds, right? People with huge amounts of capital. Now, why can they control it? Because they have so much capital to play with, right? So let me ask you this, right? Put in the chat a 111, right? If you could move the market in any direction you wanted, would you? Put a 111 in the chat if you would, right? If you could move the market wherever you wanted, would you? Right? Exactly, you would. Why? Because if you can move the market up, right? Let's say you want to buy and you can move the market up, you'd never lose. So if you can move the market, would you? Yes, that's exactly what the banks do, right? You see, the banks don't lose because they have so much capital to play with. So if they want to buy the market, they can push the market high enough because they have enough capital to inject in the markets, right? So with that being said, you see, let's go to smart money concepts. So how does the banks moving the market actually tie into how we trade and why we're losing trades and why we're winning trades, right? So the way that we're all taught trading is simple support and resistance, right? This is what you'll find on YouTube, all the small little courses that you might find. We're taught that when it gets to a support line, you buy it, and when it gets to a resistance line, you sell it, right? But for anyone that's used these concepts, how many times have you gone to sell it here, but instead it just keeps going? And then you're like, oh, now it's a buy. And then all of a sudden you get wicked out at your stop loss, and then the market goes in the same direction that you wanted it to go, right? I know that's happened to everyone because I know just before I found institutional and smart money concepts, I kept seeing that happen to me. And in my head, I was like, how can I avoid that, right? But let's actually look into why that happens. You see, I was just saying that the banks can move the market wherever they want. So the reason this happens here is because as people are selling here, right, what happens is there's stop losses formed up here. So let me turn this to red. We're getting stop losses up here, right? Maybe it's 5 pips, 10 pips, whatever. There's going to be stop losses here, which means there's money here, right? Money in the market, resting here. This is resting liquidity. So what the banks like to do, they like to shake everyone out of the market that they can. So if they can take your stop loss out of the market before they make their trade, they will, right? The banks don't lose. They just want to take everyone else out. This is why 95% of traders lose, right? Because they trade like this. They have their stop losses here, and then the banks manipulate them out. Why? Because what do the banks do? You see, the banks, they buy the market because they have so much money. They buy the market, right? So that this then takes everyone's stop loss out. So now anyone who had a sell order here, their sells have now been turned to buys, right? So this is going to inject money into the market and just keep pushing. Then loads of people are going to look at this like, oh, now it's a bullish market, we need to buy. So then they start buying. Then what do the banks do? Then there's going to be stop losses here, right? Now, what do the banks do? Now they want to sell the market. So overall, they want to sell the market. So they buy to sell. Why? Because now they can get their optimal position, right? They've shaken enough people out the market to the point where they've taken enough liquidity and captured enough money. So now they've got their optimal selling position. And this works in buy scenarios as well, right? So now they can catch an even bigger move to go and sell the market, right? So they buy it to then sell it. Now, how does this actually look in the actual market, right? So this is where you might have one big candle. Let me grab a rectangle, one big candle before an even larger selling candle, right? These are these bearish engulfings, bullish engulfings, right? Now, how does this work for us? So you see, if the banks can never lose, why would we trade against them, right? By trading support and resistance, when instead we can learn how to trade with them. Because put it this way, if the banks can't lose and we're trading with the banks, realistically, if we get in at the same place as the banks are, we can't lose, right? Obviously, we still take stop losses, but realistically, if we can get in the exact places the banks get in, we can't lose. So how does this work for us? We find where the banks have manipulated stop losses, right? They've captured liquidities. These are your equal highs, right? Triple highs, loads of wicks that are creating these support and resistance. This is where retail people trading support and resistance are looking to get in the market, right? So we wait for that. We wait for them to get taken out of the market, manipulated out of the market by the banks, right? By the people with the most control over the markets, and then they sell it off. So now the market might come down, whatever it wants to do. The market's just gonna keep going down. Now, as the market's going down, right, all these buy positions that the banks entered, they're gonna go into drawdown, right? So when you see a minus on your MT4, they're gonna be in minus right now, maybe minus $1 million, maybe minus 10 million, because this is how much money the banks have, right? They don't want to just take a 10 million loss. Why? Because they can move the market where they want. So then what do? They want to move the market back up to break even where they entered them buy positions, so that they can take their positions out of break even. Now they've not made a loss, and they can continue selling the market, right? So now their sell positions in millions and millions and millions, probably billions of profit, right? So how do we get in these markets? We wait for the banks, right? We identify where they get into the market, where they take people out, and then we enter off of here, where they come to mitigate their order, where they come to break even their order. So we'll enter off of the open of the candle that they originally bought. Why? Because then they're going to close their position here and then continue to sell the market. So we sell here with them so we can catch the rest of the move down, right? This is what smart money concepts are. Now, this is how people like Kieran, right? Like a lot of people in our group chat are catching 1 to 20s every single day, 1 to 50s, 1 to 100s risk to rewards, right? That means you're risking 1% of your account and you're making 100% of your account back, right? This is how people are making not just huge risk to reward, but a huge amount of money. Also, think about it this way, right? We all know risk to reward. If we're making 1 to 100 risk to reward trades, we can lose that same trade 99 times, win it the 100th time, and still be 1% in profit, right? That's the power of these concepts, how we can catch these massive risk to reward trades. Now, this is a basic overview of smart money concepts. I know Kieran's about to go into some detail so you can actually see these live in the markets, but where can you actually learn more on this? Like how to know when to enter, how to know when to not enter, how to know where the banks are getting in, for example. You can come to what we call bouncebacklaunch.com/bootcamp, right? You can come to this website here. This is going to give you an even more in-depth introduction, right? Introduction to smart money, why we trade this way, liquidity, risk management, structure, Wyckoff logic, right? Just another part of smart money. How to introduction to institutional candles. So this candle here is an institutional candle. Now, you might see this a lot of times in the markets, but there's only certain times where it qualifies to be a proper institutional candle. Or I know some people call them order blocks as well. There's certain things that we look for to make sure that this is where the banks are getting in, right? So where can you learn this? You can learn this here, mitigation theory. It shows you how to get in at the right times and where not to get in, right? There's so much on it. Price action, slippage and gaps, risk management, order flow. This is how to follow the markets, because honestly, this is how the market moves. And I know Kieran's going to show you that in a minute, but this is basically where you can learn it all, right? Buying opportunities, selling opportunities, everything. So with that being said, I want to keep it quite short because I know we're running quite slim on time right now. So with that being said, let me go in and stop sharing my screen. Let me actually pass it on to the next speaker now. I know he just spoke, and I know everyone knows him because if you don't know him, he's sleeping in the Forex markets, right? Now, the guy that I'm about to pass it to, like he said, I managed to retire myself through trading after 3.5 months, but none of that would have been possible without this guy, right? The calls at 4 a.m. show me how to get into the markets even better, right? The one-to-one mentorship, even just keeping my mind right, because we all know that trading's a mental game. Now, with that being said, I'm gonna pass it to the guy, the absolute man, the myth, the legend. If you're in our group chat, you're tired of seeing this guy for the past 2 days. I found another entry, another one. Like 10 minutes later, he's at a 1-to-100. So with that being said, I'm gonna go ahead and shut my mouth. I got my notepad ready to take some notes because every time he speaks, it's value. And with that being said, Kieran, do your thing, bro.
Sheesh, my brother, man, my brother, my brother, my brother. Thank you, Ryan, for that introduction. And guys, man, like, remember what Ryan just showed you was the basics, and that is the most important thing. You need to, like, in order to be a master, in order to get your 1-to-100, your 1-to-250, you need to be able to be a master of the basics. If you don't master the basics, then I don't even know what I want for you. But look, let's get into the source, and let's really start this off. So this trade here, well, this is actually a series of trades. I'm going to show you guys obviously the before screenshots in a minute. But this market got absolutely wrecked. AUD CAD got absolutely wrecked this week, man. We had, what do we have? We had a 1-to-38 risk reward. We had a 1-to-36 risk reward. We had a 1-to-18 risk reward, and we had a fucking 1-to-12, 1-to-12.7 risk reward. What does that mean? What is risk reward? This means for every $1 we risked on the first position, we made a total of 38 times that initial risk. For the second position, every $1 we risked, we made 36.4 times. For the third position, every dollar we risked, we made 18.15 times our initial risk. And for the final trade, it was 12.76 times that initial risk. And guys, that is the beauty of these concepts, is risk reward trading, because when the risk rewards in your favor, you're not trading with pressure anymore. I don't care if I have a losing trade. I don't care if I have a few losing trades, because I know I can lose way more trades than I win and still have a rising equity curve. Like, guys, we got to remember, it's not about being right. It's about making money. Of course, you need to be right to make money, but you don't need to be right every single time. And that is the beauty of these concepts. I mean, of course, you can have very, really good accuracy rates to these concepts as well, but the risk reward is everything. So let's really start to break this down. Obviously, I'll show you guys the before screenshot to show you guys exactly when this was taken and the timestamps, so we're not capping. Boom. So here's the first position. You can see up here on the top left at 12:47 BST, May 20th for the first entry, and this was an absolute screamer. So let's actually replay the chart and let's get into exactly why we took these trades, and exactly what we was looking at. Because this trade is literally, like, you literally can't make this up, man. So we was here and took this position here. Cool. So let's get in this. So first things first, right? Where was we? Right, we started off on our monthly time frame, right? What do we see on our monthly time frame? Monthly time frame, we can see the last few months we've been selling off. We have some consistent sellers coming into the market. To be honest, there wasn't a lot of analysis done on the monthly time frame for this specific position. But if we actually go down to our weekly, what can we start to see? We can see on our weekly time frame, right? Obviously, we have our low here and we have our high here. So if our weekly time frame is in an uptrend, right, and we're now retracing, coming back to the downside, what is that going to mean? That's going to mean that our daily time frame is now in a downtrend, right? Our weekly, cool, our weekly is up, right? Our weekly time frame's up. Right? Our weekly time frame is bullish, it's up. But our daily, if our daily is coming down and our daily is in a downtrend, what is that? That is simply just a weekly retracement. So what we was doing is we was following the dominant energy of the market. I mean, the weekly is bullish, but again, it's going to take a long time for a weekly setup to pan out. It's going to take literally weeks and even in some cases months or even years. So what can we see? We can see our daily time frame is down. So because our daily time frame is down, this is actually starting to create that bias for what we're looking for. And what we can start to see here is price. What has it done? As prices come into this area down here, we had what we call a redistribution of price here. We saw price come down. We sold off. We consolidated sideways, went sideways. And why did price drop lower? Price dropped lower because we had another induction of supply. There were sellers that came into the market. So because sellers came into the market, that is showing that obviously our dominant energy is to the downside. So if our dominant energy is to the downside in our daily time frame, and even if we look on our 4-hour time frame, we can see the trend a bit more clearly. Why would we want to be buying? Right? Why would we want to be buying? Why would we want to be buying if our daily or 4-hour are to the downside? We want to be staying in alignment with the dominant energy. Now, where's our structure? Right? We obviously price came in, put a lower low, put a lower high, and it came in and printed another low. Now, what happened after this lower low? We pulled back up. We created a higher high. We pushed back down, had a small retracement, and we came down to create a new lower low in the market. Why was that a new lower low in the market? Simply because of the bodies. If you look, now this is where you have to like understand in trading, right? Your devil is literally in the detail. If we really look closely to this for a second, right? We really look closely to this for a second. Look at the bodies. Look where these bodies actually closed. Notice how these bodies on this candlestick here close lower than these bodies here. The only reason that these bodies can close lower than these ones is if supply is outweighing demand. If supply is outweighing demand, if sellers are stronger than the buyers. And we know that the sellers are stronger than the buyers from what? From our higher time frame analysis. So what can we start to do now? We can start to now scale in and look for areas where price is going to start to reverse. So what did we see? Firstly, what did Ryan say? Institutional candles. We look to take our trades off these candles, and we can actually start to see our first 4-hour institutional candle back here. So what was this for? Why did we take the trade off this 4-hour institutional candle? Because this is where the supply came in the market. This is the candle that caused this break of structure to the downside. So this is where trapped orders remain, and price has to come back to mitigate that area. Why does price have to come back to mitigate that area? Why? Because the banks need to mitigate the orders. Look, you tell me, right? If like Ryan said, if you can move the markets, let me not delete that. If you can move the markets, if you have full control on where the markets go, and when the banks trade, what they do is they buy to sell, like Ryan said, right? So they enter the buy position, they brought the market higher, and then they slammed it down after. They took out any noobs in the market that were selling here, they got clapped. So what happened is we have that induction of supply here. So what needs to happen? If you've sold the market like this, right? If you've got a buy position here, right? Think about this for a second. The noobs, literally, noobs always get wrecked. All right. If you've got a buy position here, and then you've now got a sell position here, let me ask you this: if you're a bank, if you've brought the market here, and then you've then sold the market down here, and then you've took price down back here, well, your buy position is now going to be in drawdown. Your buy position is going to be in a loss. So if you have the power to move the market, why would you take a loss? You wouldn't. So what did they do? They brought price back higher. Again, why is price coming back higher? Again, enticing more noobs. People think, oh, price is in the uptrend, price is going higher. Again, getting ready to get clapped out. The one thing you need to understand about this market is that the only thing that's consistent is the human emotions and the fact that most traders lose. And that's not my opinion. That's just a pure fact of this industry. You guys need to know the industry you're in, right? In this industry, most traders fail. And again, look, how many Forex traders fail? And the reason most Forex traders fail is because they're relying on free resources on YouTube. I'm gonna be real with you. Like, I didn't learn on YouTube. Like, you got to go to a proper academy. But anyway, that's besides the point. We can see that this area here, we had that manipulation to the upside before it got taken down. So what needs to happen here is the banks have to come back up to relieve any orders that were trapped there. So if we start to scale in the lower time frame, we can see as well our hourly time frame is pushing in a nice trend as well, right? We had on our hourly time frame, we had lower low, high, higher low, higher high, lower low, lower high, lower low. Hourly time frame is nicely in a downtrend. So we can say that our hourly time frame is going down. Now, what can we see on this hourly time frame as well? We can see that we had our 4-hour institutional candle, right? If we make it a little bit bigger, we can now start to see some confluence where we can see our institutional candle has been refined. Now, if we also look on the 50-minute as well, we can see a very nice refinement. So from there, it was just a case now of having that patience to allow price to simply just return back to that area. And this is the thing, right? Where most traders fuck up, because what most traders do is they're going to create scenarios and they're not going to be patient, allow for them trades to come out. You see, what you need to understand about the market is the only way traders make money, the only way you make money is by taking the loss of someone else. That's it. That's the only way you make profit. By taking someone, it's a two-sum game. If you're making money, someone's losing money. If you're losing money, someone's making money. So you need to start to identify where the loss is going to occur so that you can position yourself on the right side of the trend. You can position yourself in alignment with institutions. You can position yourself in alignment with the order flow, right? Look at it like this. we're trading currencies, right? We're trading currencies, yeah? So a currency, think about it, a currency, current, water. Water has currents. Currents flow like a river. A bank. What's a bank? A river bank. A river bank controls the flow of water. It controls how the water moves. So a bank controls the flow of the water, which is the market, right? The banks control the order flow of the market. If you start to understand the fact that the market is very representative of water, and you can start looking at it like that, and you can start flowing with the market, trading will become very easy for you. Trading shouldn't be hard. It's just new. The only thing that's difficult about trading is overcoming yourself and overcoming your own ego. Because a lot of the time, what we're doing is we're projecting what we think the market should do. The market doesn't give two fucks about what you think. The market is going to do what it's going to do. The question is, well, let's put it like this. The market's speaking to you. The question is, are you listening? The market's speaking to you. The question is, are you listening? So we had this area. Now, of course, we could have entered here if you wanted to. I mean, you could have entered just off this institutional candle if you wanted to, stops just above the high. For me personally, I didn't want to enter there. I like to refine my trades for a much higher probability. So what can we start to see happens now? If we start to look at our area of supply and we bring this down to the lower time frame, we can see a very, 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 very nice distribution schematic. Now, what is this distribution schematic? Well, let's start to label up, right? What can we see, right? We can see our initial preliminary supplies, right? We can see what's a preliminary supply. A preliminary supply is when the market is starting to test the supply. You're starting to see these change of characters in the market. Now, again, a market can have multiple preliminary supplies, but how you got to see it is the market is going to go in the path of least resistance. So if price, look, if there's no supply here, right? If there's a supply, a wall of sellers, right? If there's no sellers here, why is the market slowing down? Why is it having deep pullbacks? Why is it getting choppier? Why is the retracements getting bigger? Why is that happening? Why are the impulses to the upside getting smaller? Because the selling pressure is coming in. And we can see that by our first preliminary supply. And then we can also see that by our second preliminary supply here. And what happens after that? We experience what we call a buyer's climax. So again, when you're actually trading this in the moment, it does require a lot more patience. And it does require, honestly, you just sitting on your hands. Like if you run a look at this position for a second, right? This position entered our supply zone at 9 a.m. UK time, and we didn't actually get filled on the entry to around 3 p.m. So you need to have that patience. So what happens next? We have that buyer's climax. Now, after your buyer's climax, what can we see? We have an automatic reaction. You see here, the buyers they literally start to get trapped. We have that initial buyer's climax, and we have an automatic reaction. They're saying, okay, there's sellers up here, and the automatic reaction is saying, okay, the buyers have now been climaxed. They've had that climax, they've reached their peak. So now we've had that automatic reaction. We have an induction of supply. We've had supply enter the market. And what we can see happens here is what we call a change of character. Right? A change of character is when we're starting to enter our trading range. Right? We're starting to enter our trading range. But bro, there is still liquidity, no? Watch. So what can we see? We can see our first change of character. This is showing us that we are now changing market conditions. Because what's the market going to do? The market is going to be in a downtrend. It's going to be going sideways, or it's going to be in an uptrend. That's literally all it can do. All right. Shout out Trade House. That's literally all it can do. So don't overcomplicate it. So now what happens? Price now comes in to this area. We have our automatic reaction. We then experience what we call a secondary test. This secondary test here is testing that supply, is seeing how valid that supply is. Now, notice that supply, what does it come and do? The supply now gives us a sign of weakness in phase B. We have a sign of weakness. Now, if you don't know what this is, again, would you not see that liquidity is rested? No, this was liquidity capture. You'll see in a minute. But again, right, we have that sign of weakness in phase B. What happens after we have our sign of weakness in phase B? We have our first up thrust. We have our first liquidity run. We have our first liquidity run in the market. Right, now, again, this is a pair like AD CAD. There's not a lot of liquidity in this. So look, we have our first high here. Plus these highs are equal as well. If you want to go to the, if you want to go like to maybe the 5 second, right, you can see how equal those highs are. Right, you see that resting liquidity up there. So if you just go back to the 1 minute, because I know not a lot of people have the 5 second. What do we have? We have our first trading range being formed. We have our first high getting clapped. First high, wick comes up, takes that out. Now, what happens now? We have now entered phase B in the market. Phase B is about building the cause. Phase B is about building the cause. And you need to understand that when you come into phase B in the market, because you got different phases, right? You got phase A. People tell you stay away from. Let me ask you guys this, right? Put a 111 in the chat if you've ever been told to stay away from consolidating markets. Put a 111 in the chat if you've ever been told to stay away from consolidating markets. I have. Now, that information is completely wrong. You only stay away from consolidating markets if you can't overstand the consolidating market. Consolidation is a mechanism. The market is intentional. The market is all like. Now, let me ask you guys this, right? Put a 2-2 in the. If someone said at IML, this is funny because that's exactly how I learned. So if you want to diss it, then you can get off this call. But what happens now, right? We have our phase A. Phase A is your stopping action. Phase A is the stopping action. This is when we are stopping our prior trend. And you need to be able to break down these different areas and start to understand what happens so that you don't enter the market prematurely. Now, we have obviously phase A, which is your stopping action. It's stopping the prior trend. Now, what happens? We now move into what we call phase B. Phase B is about building the cause. Cause and effect, right? Law of the universe. The market is never random. Wait, CAUSC. Yeah. So we're building a cause. What's happening here? We're consolidating. We're moving sideways. We're enticing noobs in the market, right? People entering early. What happens? We exit our trading range and we also get a major sign of weakness. We have a major sign of weakness. What happens? Now we move into phase C. Phase C is where you want to start to engage the market. You want to start to be looking, okay, let's start seeing, because phase C is that final area, is what we call our up thrust after distribution in this specific schematic. This is where you're shaking out every single trader. Now, if, for example, you perceived this, like let's say, I'll be real with you guys. I did actually take one loss getting this trade. I'm gonna be transparent with you. No one's got 100% accuracy rate because you do got different type of schematics. You do have one schematic where you just get an up thrust and you don't get your up thrust off the distribution. So this is why you have to accept risk and you need to emotionally accept risk. If anyone tells you they've got 100% accuracy rate, they're wrong. They are lying. You will lose trades. It's part of the game. But you need to understand and be able to manage your risk and emotionally accept the risk. You see, why did we take this trade? Well, we took the first position off this little institutional candle here, assuming that, okay, we may not get a UTAD. So what happened? We took our initial trade here, 2.1 pip stop loss. Price went down to 1 to 3.8, come out of our trading range. So obviously, what did we do? At that point, we broke the trade even. We moved our stop loss to break even, and then price come up and took us out of BE. No problem. It's a loss. So what do? We don't be emotional. We don't cry and say, oh, the market hit our stop loss. No, losses are okay, right? Losses, it's okay. There's nothing wrong with a loss. Before you can win, you need to learn how to lose. If you can't deal with losses in the market and you can't overstand them and let them do what they have to do, then I'm sorry, but trading is not for you. Losing is part of the game. How you need to look at your losses is they're simply business expenses. And the reason I took that trade there originally for the first ones, because I was looking at it as a up thrust, because sometimes you don't get schematics with a UTAD. Sometimes you won't get that final push to the upside. And if you do, well, doesn't matter, because now you know, cool, you hit one loss, one break even. And even if it was a 1% loss, right? These gains completely cover all your losses. So anyway, we come into phase C. Phase C is that final manipulation. And what do we have after our phase C? We have our test. We have our initial test, right? We test, we're mitigating any orders back there. And after we come into that phase, it was simply just a case of identifying that test. And it was just about basing one of our entries on there. So we could literally base the entry on the fill of our imbalance, stops just above the high. And we can see obviously what happened next. Price trades back. There's our play feature. Price starts to trade into our entry, fills us for our trade, gives us another test, and now it finally leaves our trading range. So that was one entry. Entry one, filled. Entry one, filled. Now we'll get into targets as well. We have entry one filled. What happens next? We have entry two. We have our second entry where we come up to now, because what happens now? We've had phase C. Phase C doesn't last long. After phase C, let me draw this after the test. When you exit your trading range, you're now in your final phase. You're in phase D. Phase D, now I must say, entering positions for the test, the UTAD, a little bit more riskier, but again, it's all down to accepting risk, right? And not really being emotional about it and knowing what you're looking for. Like loss is not a bad thing, man. People need to stop trying to lose and start trying to win. So anyway, you're in phase D. After in phase D, what happens? We now have another sign of weakness. We have now exited our trading range. This is where you can now, let me move this actually here so it doesn't confuse you guys. Right, so now we've exited our trading range. What can we do? We can simply come in and enter on our next level of supply, right? We have a little drop, base drop, little price supply zone. As you can see, price comes in, wait for it as a breaker structure. Price comes in, breaks the structure, and then fills us for our position. So again, this specific trade like this, I was originally looking at this level up here, right? Up here. You see this institutional candle, but it never came up. So in that case, it never came up. We can see that price traded and started to trade bearish structure. Low, high, lower, low, pulls back into our institutional candle, and then drops lower. And this was the entry here. This was the second entry on this air. We didn't take the entry here because there was no institutional candle just yet, right? We didn't enter here. This wasn't the entry. The entry wasn't off this. We ideally wanted to see it up here. That institutional candle, top of the range. And the reason we wasn't going to enter here, we don't enter trades in this area because we don't trade off imbalance. I don't enter off imbalance. And the reason I don't like to enter off imbalance is because it's not really a factor of the market. So what can we see? We can see prices now exited our trading range. And now prices exited our trading range. We are now in a completely different market. You've had another change of character. You've exited your trading range. And now price is in a downtrend. Price is starting to drop off. So it's now just a case of just respecting the order flow. And at this point here, you got to understand where you are in the picture. You're in your higher time frame supply zone, right? You're in your higher time frame supply zone. You're in alignment with all your higher time frames. So the lower time frames are just going to mirror what the higher time frames are doing. And it's just a case now of just being patient and just being able to take those trades when they come in. And again, what do we see? Lower low, pulls back into the institutional candle, and it starts to drop off. And you can see that price literally just respected order flow. Now, where are our different targets? Because having targets is very important. So our first target and our first level of taking partial profits was at this resting liquidity down here. We can see in this fat wick as well that normally these fat wicks have a lot of lower time frame imbalance, so they can be magnets. Now, again, imbalance is not an entry. It's simply just an area of inefficiency which needs to get filled. There was also a very nice as well. If you also look at your volume profile as well, we can also see that our point of control, where is this? We can also see that where our point of control was as well. We can see that most of our trading range, most of our liquidity was in this distribution as well. So what does this mean? What does this mean? This means that most of the volume is happening here. And what you can do, you can literally just use the volume profile as confluence with institutional candles. And basically, look at this, right? Look at the bulk. Just look at the bulk. This is very easy to understand. Look at the bulk. Right? This is showing you orders. So look at the bulk of these orders here. Look how fat this is. Right, let me use this arrow here. Look how fat this is. Now, I can even put the actual orders on. I'll show you. Look how many orders were placed up here. Right? Look how many orders. We're talking thousands and thousands of orders. Now, combining our higher time frame supply zone with our lower time frame distribution, and the fact that we've got a lot of orders being induced in the market here, and if there's not many orders down here, where is the path of least resistance? The path of least resistance is to the downside. The market's always going to go to the path of least resistance. The path of least resistance is to your downside, because look where the bulk of the market is, right? Again, like you can go and back test this yourself, but again, we use these for more compliments. I learned this from Lex Waves as well, so shout out to Lex Waves. But yeah, we can see obviously that was the bulk of it. Very thin liquidity down there as well, especially very, very thin liquidity. So because there's thin liquidity, price won't have a problem coming back down there. That was obviously the first fill. Where is it? Go back to the M1. That was obviously our first fill up there. Let me remove this. Very nice. That was obviously our first fill. And we can see obviously on the re-entries overnight, we'll get into the re-entries in a minute, but there are our first initial trades. And obviously they completely slapped our targets. Now, why were our targets at this level? Why did we try to target 0.93150? Simple, right? Simple, simple, simple. Measured moves, right? But we're not. Yeah, we'll get to measured moves. So simple, simple, simple. We can see price made an impulse. The downside traced. Now this next impulse should be similar. How convenient. Very, very similar. So if we now take the length of this one, put it on our institutional candle, we can see that this now starts us to bring down here. So, okay, so this is now our target. So what was our final level? It was simply just a Fibonacci extension, low, high, low, and then we can see our 1.27 Fib extension. That was our final target, and then boom, how convenient is it priced? It comes down to our target and then reverses. And then the rest of the trades were literally just re-entries at night. Now, this one, I'll be real with you guys. This trade here, like I don't normally take trades at like this time, but because of the higher time frame analysis and because of like just how perfect this was and the redistribution that occurred here, it's too good not to take. Too good not to take. What was this trade based off? This trade honestly was just very low time frame. Just again, order flow, market structure. What can we see? We can see obviously price lower low, lower high, lower low. What did price do? Move this right. What did price do? Comes back, traces into our institutional candle. Now, again, for this, I didn't want to put my stop loss just here, just in case it wanted to come and mitigate any of that. So I decided to be a little bit safer, put it slightly above the highs. It's just, I think it's a 3 pip stop. Yeah, 3 pip stop. Count for a little bit of spread as well because it was late. Normally at late nights, I find that liquidity is a bit more thinner. And obviously, yeah, that was the re-entry. And then again, there was another re-entry today, New York Open, which was literally very simple. Very, very simple. Same thing. Lower low, lower high, lower low, pull back, institutional candle, drop off. Same thing. Like, it was very simple. And yeah, that was the trade. So that was it. Like, obviously, it's got, you know what I mean? Like, that was the trade. So obviously, this trade combined, let's calculate all the RNRs together. So we had, what was the first one? 1 to 38. 38%, 6, 18, plus the final one is 1 to 12. Yeah, 1 to 12 plus 12. There you go, 104% potential gain. Risk 1%, make 104%. Risk 2%, make double that, and so on and so forth. So yeah, very, very nice trade. Very, very nice trade, man. It wasn't like, he's got to keep it simple, man. Like price action, and market structure is pretty much all you need, family. Sheesh, let's look at the chat. Sheesh. Where's your partial taken usually? So partial profits are normally taken at devil's advocate positions. So areas where the devil's advocate can show up. If price gives you the setup, will you take it regardless of time? And time can be considered out of confidence. So it normally depends. Normally, I don't like to take trades out of my trading windows. But just in this case, because of that, of course, if you're taking trades out of that, reduced risk. This entry was reduced risk as well because of the trading times. So if I'm going to take a trade out of that, it's going to be reduced risk. And that's how you got to do it. Just manage it according to your risk. If you're unsure of the trade, or if it's like, or if you're confident in the trade and it's maybe like something you don't normally take, like let's say your time is one of your confidences, right? Let's say you normally trade New York session. Let's say this happened in Asian session. Well, firstly, the currency pair is AUD. AUD can be traded during Asian session. Now, I passed the FDMO trial with a 1 to 54 risk reward in one trade during Asian session. Like, time is important, but market structure and the order flow is more important. And the currency pair you're trading. You will find it under the indicators. Yeah. So again, I'm not an indicator trader. This is just something I use for confluence, volume profile, and then session volume. You need the paid trading view for this. Would you enter off a close of imbalance? Nope. I don't trade off imbalance. So what makes an IC valid? If it breaks previous structure, yes. And there's a few other piece of confluence for that as well. It needs to mitigate. It needs to be mitigated, and it needs to take liquidity. It's all about the means behind it. How do you know it's an institutional candle? Well, think about it, right? What did Ryan teach us at the start? Ryan taught us about support and resistance and how the retail community buy and sell and put their stop losses here, right? They put their money up here. So who in their right mind, if everyone is taught to sell at resistance, who in their right mind would buy at a resistance level? Think about it. The only people in the world that would do that are banks, because they're the ones that can move the market. Every move in the market is intentional. Every move in the market is intentional. It's about understanding what the move is and what's the intention of it. Chat, look at the chat, look at the chat. Anyone want some cookies with that goat's milk? It's gotta be vegan, bro. There's gotta be vegan, man. Which I don't know what that is. Because sometimes it'll work. What currency pairs would you recommend beginners studying? Well, it depends if you're intraday trading or if you're swing trading. If you're intraday trading, stick to a few. If you're swing trading, you can look at them all. What is the greatest lesson you have learned? That is a very, very good question. What is the greatest lesson I've learned? Firstly, is being coachable. Like that's the biggest one, man. Being coachable, bro. Because like, don't get me wrong, man. Like the biggest lessons I've learned are off the charts. Let me put it like that. Like the key to success is not on the charts, bro. The key to success is off the charts. And the biggest lesson I learned was being coachable to my mentors, because I remember, right, like Pip, like you guys know, right, Pips of Persia is my mentor, right? He, you know what I'm saying? So when it comes to him, like I remember he used to tell me shit, yeah, and I'd be like, yeah, that's sick, but I just wouldn't, like, I'd acknowledge it, but I wouldn't actually go and apply it. You know, I remember he used to tell me like, bro, like I'd spend, you know, like when I first started trading, I was spending like 5-6 hours a day on the charts every single day. And I was like, all right, cool. I just wasn't putting in that time in. I was thinking, yeah, I can have the success, but I wasn't putting the time in. He was telling me to include the 4 pillars of trading, and I wasn't doing any of the 4 pillars of trading. And I was what he'd tell me to backtest. He'd tell me to look at certain setups. He'd tell me to attend certain educators on Go Live. Like, for example, Lex Waves. Like, I'll be real with you, right? Lex Waves on Go Live. Like, look, where is he? I used to hate Lex Waves. I'll be real with you. I used to hate this guy so much, right? And where is he? I used to hate Lex Waves, yeah? And not because he's a bad trader. He's one of the best traders. But because I had an ego, I wasn't being coachable. And then when I dropped my ego and actually was like, you know what? It's not about if I like him or not. The guy makes money. And if he taught my mentor what he taught him, I need to learn from him, right? So I dropped my ego, went back to the basics, kept it coachable. And then, yeah, like I love him to bits, bro. He's such a good educator. So yeah, that's probably the greatest lesson I learned, man. Taking it back to basics and being coachable to the people that had the results I wanted. Because I had to realize, like, if my way worked, I would have the results. My way didn't work, so I needed to use their way, if that makes sense. So that's probably the biggest lesson I've learned. Being coachable, bro, and taking it back to basics. Have you seen Mauricio, the educator flow and equity level up video? No, I haven't, broski. I haven't. Can you explain how you did the second trade? Yeah. So the second trade was this one. So second trade, very simple. I was looking to get another entry actually. Here, I'll show you, but it missed it. Look how close it came into that. Oh, but anyway, the second trade was literally just, I'll go and replay it for you. So the second trade was here. This is what we're looking at. And this was based on, I think, 15 seconds. Yeah, 15 seconds, a lot clearer. So we had our schematic, right? We had our trading range. So we had our schematic. And what happens when we come out of consolidated markets? We will start trending again. So what happened? Yeah. Today was a very good day in trading, man. I can't lie. But yeah, sorry, I was thinking about the P&L on this. But yeah, so price might drop low, lower high, lower low, and then yeah, pull back, institutional candle, and that was it. Like there was literally nothing else to it. That was it. Comes in, drops off, and that was it. Like honestly, that was the second trade, bro. That was it. You have TMO funded, yes, Sirski. When it all clicked for me, so when it like, there's gonna come a point in your trading, yeah, you're just gonna have that breakthrough. There's gonna come in your point in trading where you're gonna have that breakthrough. Like it's different for everyone, man. Like for me, it just happened after just putting in the time, bro. Like just trusting the process. Like I remember times, yeah, like just being frustrated, bro, because I couldn't win a trade. Just being frustrated for it. Like I remember times, yeah, where it was blown account after blown account after blown account. And if you're in that phase right now, keep going, because what's gonna separate you from the people, from what's gonna separate you from your success is if you keep going. You see how you got to see it, yeah. This is just bigger than actually just trading. It's bigger than just looking at a chart. because what you're asking from the universe is you're asking for a skill set that can pay you and your family for the rest of your life. You're asking for to be a trader and to extract money from the largest financial market in the world. So you're not just going to get an easy journey. You're going to get all the circumstances, the people, the places, and the events that are going to make you into that person who would make you worthy of having that results. And one day it will just click. So what you got to do is just trust the process. You got to get a mentor. You got to get an educational course. I mean, don't get me wrong. You could probably be successful on YouTube, but if you're spending all that, like, but would you do this? You could probably be a successful surgeon by learning on YouTube. You probably could, but would you let a surgeon who learned on YouTube operate on you? I wouldn't. I wouldn't. So, like, you just got to trust the process, man. As cliche as it sounds, get a mentor, get someone that's got the results you want, get an academy, and just plug in and keep going. As cliche as it's going to sound, don't give up, because what's happening, you're going to get tests, because what you're doing is you're trying to compress, 30 years of success in a year, right? You're trying to get 30 years of results in a week, in a day. So, firstly, you need to understand that this is going to take time. It's going to take time. And during that time, you will have that breakthrough. It's going to be different for everyone. But again, it depends on things like what are you actually doing. If you're putting in 10 minutes a day, it's going to take you a long time, right? If you're actually, and I find it funny how the call starts to drop down as we start talking about psychology, because this is what separates successful traders from non-successful traders. Like, if the keys to trading were found on the chart, guys, everyone would be successful. And you got to understand the reason people are not successful in the market is nothing to do with the analysis. Oh, I mean, it is to an extent, but you got to understand that it is the mindset. It is the dealing with greed, dealing with fear, processing your emotions, understanding yourself, knowing yourself. But again, we can talk about it all day. So when it all clicked for me, it happens in points, right? You're going to have basically different clicking points. There was no one time where it just clicked once, and all of a sudden start making money. There was breakthroughs. And each time I had a mini breakthrough, that led to the next mini breakthrough. And that led to the next mini breakthrough. And that one to the next one. And it comes down to, what you're doing. If you lose a trade, what are you going to do about it? Are you going to go and cry and say, oh, trading doesn't work? Or are you going to go back and review your losses? Are you going to go and ask your mentor, hey, bro, I lost this trade. Can you help me figure out why I lost this trade? But that's, speaking of which, that's exactly what we're going to get into now. So if anyone's got any losing trades they want us to review, we can definitely get into that. Oh my God, we got a lot of questions coming in. What are the 4 pillars of trading? Oh, we can't get into that today. So 4 pillars of trading are trading, journaling, back testing, go live, and forward testing. Go live, back testing, journaling, and forward testing. Go live, back testing, journaling, and forward testing. How can we access this training? So if you got the link from my Telegram, or if you got the link from someone else, go back to them and ask them how to get access to the trainings. What we'll do, we'll set on your call, we'll set up your account, and you'll get access to over 150 educators who go live every day. How important is a trading plan and following it? Everything. And guys, if you got losing trades, submit a losing trade now, and we can start looking at losing trades. Having a trading plan is everything, bro. You have to follow your plan. So think about this, bro, right? If you don't follow your if you're not following your plan, why are you trading? You know what I mean? It's like this, right? It's like, okay, imagine getting on an aeroplane, yeah, to go on holiday, and then the pilot doesn't follow GPS. Bruv, you know what I'm saying? I'm in IM Academy. Sheesh. I've never watched Sandy. I can't lie. What is Sandy the GOAT? Yeah, Sandy got the source. And for a demand zone to be a demand zone, does it have to create a higher high? Yes, it does. Psychology, the realist. That's it, guys. Psychology is everything, man. Like, because this is another thing, yeah. You don't trade the market. You trade your belief system about the market. You don't trade the market. You trade your belief system about the market. I'm gonna let you digest that. Okay, Alice has got a trade. Let's have a look. Okay, cool. Interesting. Where's this GBP USD? So off this trend of this is because it didn't create a higher high. If you was entering, there's a pen. So if you was like, it depends where you're entering from. If you were entering off like here, for example, and it comes back down into that, it didn't create the new higher high. Price didn't go and create that new higher high in the market. I'd look for slightly higher time frames as well, institutional candles, like hourly at least. But again, I'm more of a swing trader. So for an intraday position like this, again, that institutional candle didn't look like it created a new point of structure in the market. And again, when you're taking your stops, you always want to put your stops in a safe area. You're going to put your stops below the low. So something like that, cool. Maybe that might have tagged you out once, but it is what it is. I mean, personally, on a position like that, if you're looking at that trade there, again, I would have wanted to see that come and create a new high in the market. Because notice, look here, for example, when we had this impulse that created a new high, we obviously had supply here. We reaccumulated to break that structure. So this was the point that broke structure. And notice how we come back and trade into that point. So this wasn't a valid demand zone because it didn't lead to that break of structure.
So I've entered literally where you're showing now. I've entered there. I didn't enter from there, but I entered there. So that like I took the break of structure. I took break of structure as the high on the left. That one.
So like here.
No, not from that one.
Here.
No, go left.
Yeah.
Yeah. That was my that's where I entered. Yeah.
So like this, boom,
Yeah.
boom, boom, and you saw that as a BOS.
No, the first one. The first one.
Yes.
Yes.
Yeah.
Yes.
So yeah. So personally, I wouldn't look at the 5 minute unless I'm in a higher time frame zone because there's no high like. I mean, what is this zone here? Is there a higher time frame zone here?
I can't remember.
So yeah. So like for me, I like to see the higher time frames, much a higher time frame zone. But personally as well, like this issue, realistically, if this was valid, this should have went straight up path of least resistance. And look as well, look how slow and choppy it is. This is just part of that retracement. Again, when you're getting in trades, you want to be in the impulse. You want to get on those impulsive trades. This one here, this re-entry here, simply because your stop loss placement. So with this one, your stop loss should be below the low to keep it safe. So it looks like maybe on this, you're trying to put your stop loss to kind of get yourself filled in the trade potentially and to have a bigger risk reward instead of protecting yourself.
Yeah, I was that's the thing. I was entering it from 3 minutes, and then when I came back to it, I seen like even because like I'm trying to really like stick with minimum, like the minimum goal to 5 minutes, don't go lower, at least for now, you know. When I seen it after, like when I looked at the 5 minutes, I would do my stop loss higher, but because I was just looking at the 3 minutes or 1 minute, my stop loss was lower, so literally it stopped me out. Yeah.
So and again, like if that is your institutional candle as well, like either ways, whatever time frame you're looking at, if you're looking at that is the low is there.
Yeah.
So you want to put your low below the low. You want to put your low somewhere. Or your stop loss again. What's your stop loss? Your stop loss is your safety net. So you want to put your stop loss somewhere where it makes sense. So if your stop loss gets hit, it's telling you that your trade's invalid, your trade's wrong. So in this case, again, just for future references, I wouldn't try to make smaller stop losses just because. Always put your stop loss in somewhere safe.
Yeah. Yes, sir.
Okay.
Well, I appreciate you.
Got you, yo. But I mean, to be fair, this was a nice reaccumulation as well. Yeah, nice reaccumulation. But I like to look at higher time frames a bit more. But again, it depends on the type of trade you are.
So when you say like you like to look at the higher time frame, so when it comes to like break of structure, you're looking at higher time frames, not just 5 minutes, or what do you mean?
So if I'm looking at like 5 minute or 1 minute break of structure, it has to be in a higher time frame point of interest.
Yeah.
It has to be at least like an hourly or 4 hour.
Okay.
I got you. What is your Telegram? My Telegram is t.me/IK Davis. But yeah, so again, with those stop losses, guys, like that's how I used to do as well. I used to try and make my stop loss smaller because I was comparing myself to other people. I was seeing other traders having small stop losses, and I was making smaller stop losses because I wanted a smaller stop loss. Again, fuck anyone else. You're the best trader you know. So make your stop losses somewhere where it's safe. And again, there's nothing wrong with getting like a 1 to 3 or a 1 to 4. You need to get consistent 1 to 3s and 1 to 4s before you can get 1 to 10s or 1 to 100s. Like, you know what I mean? You have to put your stop loss with somewhere safe. It has to make sense. So safe areas. Let's have a look. Can you show sign of weakness on phase B? You got. Let's have a look. on this one that Bavik sent in. Let's have a look. So it looks like on a position like this, you're just being a little bit impatient. In terms of this looks like this was your POI, this was your point of interest, and you obviously was being impatient for price to come and hit your point of interest. Let's have a look at this 12th of May. 12th of May. Again, like something like this as well. What you could have done is you could have scaled in to there and waited for your lower time frame confluence to take the trade instead of just basing it off that. And again, if your like point of interest is high like that, you got to wait for because your point of interest needs to get mitigated, and your point of interest wasn't mitigated yet. And if we're looking at this as a distribution schematic, I'm gonna call PS bound climax automatic reaction. I wouldn't have said that's a UTAD because you didn't have a phase, you didn't have that phase B, you didn't have a build of the cause. You know, when it comes to schematics, a schematic needs to it takes time, right? Because what is phase B? Phase B is about opinions being formed. Phase B is about enticing traders in. Oh, let me buy the market here. Let me sell the market here. It's enticing people. So it's just having that extra bit of patience. On a trade like that. And again, like for me, I would have scaled it into there and look lower. So when it comes to this, you can scale into that, understand the fractals. That's going to be the same. So it's just having that extra patience and allowing price to do its thing. And again, it didn't even meet your higher time frame point of interest yet. So I'm guessing this is a higher time frame POI. Obviously, I can't see it. And again, you're counter trend trading. Like the main trend is to the upside, so you're counter trend trading. Dude, like, you know what I mean? So that, like, you're trying to get the crumbs of the market. Don't counter trend. Like, if you're new, don't counter trend trade. Stick with the bigger moves and get the bigger moves the market can offer. You want the whole loaf of bread. You don't want the crumbs. Now, obviously, if you're a bit more advanced, you can counter trend and hedge yourself in that, but I wouldn't advise it for new. What's this? So what do we have here? We have. I'm guessing this was a winning trade. I'm guessing, or like, where's David? Where are you at? I'm gonna have to shoot in a minute, family. But David Broski, what's this one?
Yeah, bro. So I was looking at AU on a 4 hour. So we're in a uptrend. Manipulated always broke structure that early IC. You can see we accumulated there, and then obviously we had that 15-minute break of structure. Yeah, and then I based my entry off a institutional candle with imbalance. And then I had a manipulation of lows. So I had the 3 confirmations for an institutional candle, and then obviously I took the trade off there. My final TP was at low resistance highs there, but I ended up revising my stop loss there, where it shows, I revised it to there because I was just looking at like the hourly structure. So that was like the most recent higher low, and I was just kind of wondering why it I kind of do know, but I was just kind of more hoping that it would come a bit. It was literally like 7 pips off or something like that off the TP. But if you look on the daily, it was actually a drop-based drop on a higher time frame. So maybe that was the case, because I literally put it up, like the final TP was like literally right.
Where are we? When was this? What day was this?
14th, 13th. May.
Where are we? Oh, here. Yeah.
Yeah. So if you go into the daily, you can see it's a drop-based drop. Yeah. Yeah. So my TP was literally where the start of that drop-based drop wick was. So literally, that was my final TP. Yeah.
Well, yeah. So again, it's just about, okay, cool. So in this, it's just looking on the lower time frame. So cool. Obviously, your daily time frame is there. Cool. You got your higher time frame analysis, which is good. So in the case like this, obviously, if you've got your higher time frame swing, when you got to look at your confluence, you see here, cool, what happened? We had a price came low, we had a redistribution, supply getting introduced to the market, and it went lower. So it's overstanding the fact that this is your induction of supply here. So this is your devil's advocate area. So an area like this, we can see, oh, how convenient, right? This is your devil's advocate price comes in, trades into that supply. That's also a drop-based drop, right? Drop, well, drop, base, drop / institutional candle. So again, this is that devil's advocate area. So personally, like when I see something like this, I basically would take partials. Like the best thing to do is take partials, bro. So like I'll never hold a full trade with volume to the full target because it's got to be insane to do that. Because obviously the market, like what does Mark Douglas teach? That the market is completely random. Every moment is unique. So how we could have managed this, bro, is you could have obviously marked this up. Like great trade, by the way, right? Great accumulation, fucking like textbook, right? Textbook. Absolute textbook.
Very clean,
break the structure, like boom, like banging, beautiful. So textbook, maybe it's just a case of the trade management. So like I like how you had your stop here as well, which was good. What you could have done obviously is you could have seen, okay, as price is coming into that supply zone, let me go in the lower time frames and monitor it. So what I would have done is I would have had an alert in that area. I would have set an alert there, price trades into it, and I'm now going to watch it. So I would have been like, okay, cool. So price is coming here now on the lower time frame. Bet let's say cool in a lower time frame. What can we see? We can see price obviously trending, right? Boom, 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 doing its thing. Boom, 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 boom. Reaccumulation. So this is where the demand's in the market. So for me now, what I'll do is something like this: monitor here. I'd probably put my stop loss below here if I took that trade, and then just watch it and see what happens, bro. And then realize that okay, if this is because obviously at this point in time when you're in the trade, you don't know if that's gonna obviously blow through or if it's gonna react, right? So this is where obviously your understanding of supply and demand comes in. Understand that okay, this is a supply zone and we're having a reintroduction of demand here. So if we're reintroducing demand here and demand's coming in the market here, again, reaccumulation, manipulation of lows, breaker structure to the upside. So if this is a potential demand zone to go higher, price should not come below this demand. And the second price eventually broke that would be my signal to get out. So I would have had my stops below here, resting, probably a little bit below there, not at the low just in case, just like that. I would have partialed. As soon as I hit it, I would have partialed out with the trade. Close some of the volume. How much would have closed depends where your targets were. So okay, in that case, it's so close to your target, bro. Like you could have just closed out the whole thing. You know what I mean? Like it's so close, bro. Like to your target, man. And as well, like because that was a supply zone as well. You should have put your target maybe a little bit lower. It's a little bit lower because it was a supply zone. And obviously supply got introduced to come and obviously break below these levels of demand here. So again, just monitoring that. So even if you had your stop below there, it's a case of obviously call price doing its thing. That takes you out. Boom, trades over. Is what it is. Trades over. And the thing is, because it was so close to your target anyway, like you could have closed it. But partials is everything, man. But does that make sense about like monitoring those supply zones and seeing how it reacts?
Definitely, yeah. Like I went back and looked at the trade and I just saw that supply area and I said to myself, like, I'm gonna start marking out and setting alerts on them devil's advocate positions basically.
Yeah.
How they're
banging. And it's just obviously just about being mindful of that supply there.
Yeah, definitely. Appreciate it, bro.
Yeah, banging. Like obviously you could have like targets if you wanted to, like above here or something, but then that's where you just partial, innit? And do your thing, man. Partials everything, bro. Pay yourself first, because how I see partials is like, all right, cool. Let's say for example we're in a trade, and let's say you risk again, past products don't guarantee future results, but if you risk $100, let's just say, and then let's say you're up a 1 to 10 and you're up like $1,000, bruv, pay yourself, man. Close even close 250, close 500, bruv. Close it, partial out. Again, it all depends where your targets are. Like it depends if your targets are 1 to 20 or 1 to 30. Again, it's all different. But the concept I'm saying is pay yourself first, because if you're up $1,000 on a trade, right, bro, that's someone's monthly wage. Pay yourself £500 and then close half your lots, close quarter of your lot size, whatever it may be, and then now you're floating an extra 500. Now you got 500 floating. That extra 500, that's anyway money. Like that's anyway money. You paid yourself first, you got yourself paid, you've made your money, withdraw, whatever, do what you want, compound, whatever. Take that money, do what you want. Now the rest is anyway money. Your stops are managed, and the rest is just anyway money. And that's the power of partialing. And realize that, like, how do you not become emotionally attached to your profits? Realize it was never your money to begin with anyway. And when you realize it was never your money to begin with, you're gonna be a bit more grateful to take partials, and gratitude. So yeah, partials, bro, would have helped you with this. And again, targets in that case, because of the supply, I wouldn't have had my target above that. I wouldn't have had it above that, just below it. And that's where you can investigate on your lower time frames. Again, don't be afraid of lower time frames, because lower time frames are just zooming in. That's it. And lower time frame is literally just a zoom. On a 4 hour, again, drop, base, drop. If we zoom in to the M15, you can see it a bit more clearly.
Yeah.
So yeah.
The distribution, yeah. Appreciate it, bro.
I got you, my brother. Let's have a look. So we got Mo Euro GBP. But yeah, great trade, man. Great accumulation. Institutional candle, banging. Have a look. Mo. Where are you at? Where's Mo? Where is these participants? Mo. Yo, my bro. Oh. No? All right. I guess no. So let's have a look at this. Well, yeah, because you're selling in against market structure.
Can you hear me, first of all?
I can now. Yeah, we saying.
All right. So, well, first of all, bro, appreciate you for doing everything. So,
you, bro.
the schematic that you see, I marked up at the end of the day. I did not see that spring. I did not. I thought it was a distribution first, because you see we have 3 impulses to the upside. And I thought that would be a U-turn, because after those 3 impulses, we had that bearish break of structure after the SOS that I just did. So I was more on the bearish side. Also, I think I had confluence with some other pairs. So took it the first sell. The first sell, it went in profit. I got some partials, and then I was out at break even. And then basically, so yeah, the reason why I think I did not look at that spring was because I was in profit from that sell. So my mind was focused more on the bearish side. However, I did do that devil's advocate where I have the golden M5 88.6 level, which is normally where I would just close, or if it was a short-term trade. However, as I said, I wasn't looking at it, and I wanted the pair to drop even further to take those equal lows where there's the selling climax. I wanted those to be captured. And then obviously price reversed up, where I got a second entry, which gave me a little bit of profit, but then it went to break even. And then after, when the pair continued to rise higher, I understood that that was most likely a spring from my M5 88.6 level. So,
yeah. So yeah. I mean, like, okay. So if we're gonna break this down, then yeah, cool. So if this is like forgetting, obviously you can see that the higher time frame is an uptrend as well. So is understanding that because of the higher time frames in the uptrend, what's the intention of this distro? Why are we going to distro here? Well, if we're going to distro here, it's going to be probably to retrace slightly on a higher time frame. Of course, these equal lows, of course, we wanted to see them get clapped. And another thing as well, the time frame is very, very low, 3-minute time frame, man. Like, of course, you can go on your M3s and your M1s, but the only way I'm on an M1 time frame is if I'm in a higher time frame point of interest, like this, right? So let's say, we're buying, boom, 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 and you've gotten like a 4-hour or a daily point of interest. Like, I'm not going to jump on the M1 and just try and identify institutional candles. That's how you blow accounts. That's how you take a lot of losses. You have that institutional candle here. Well, this is the model I base off, right? I have my demand zone, understand that price is going to be on a downtrend on the way down, and I want to see those entry requirements. I want to see that breaker structure, head and shoulders, schematic, or the liquidity run. And then after we get that, now I can enter on the M1, because it's going to flip first on the M1. But the only way it's going to flip first on the M1 is to go with the higher time frame momentum, if that makes sense. So that's how you get those trades. Like, instead of just jumping down to because there's no confluence here, right? This zone's got no confluence. This is just a random 3-minute, or even this one, right? These are just random 3-minute candles. So for me to take a trade, And the way that like I kind of built my trading plan is I want to see that higher time frame demand zone, and then price come down on the lower time frames to retrace, and then give me the lower time frames to flip with my higher time frame. So what I'm saying with you, bro, to kind of like maybe avoid some of these losses is step up the time frame a little bit, bro. Like a 3-minute time frame is like, that's the thing, bro. These lower time frames is a lot more data, so you're going to see a lot more, you know, schematics. You're going to see a lot more institutional candles, but they may not be the higher probability trades. They may not be those big monster risk reward trades you want. But you know what I'm saying? There might not be those bigger monster risk reward trades. So it's just about overstanding and trying to see what the higher time frames are doing and getting more alignment. And for me, like I only place trades when I'm in a higher time frame like demand zone. You know, hourly at least, 4 hour. Obviously, I want to see daily, 4 hour, hourly, all in one. But for me, I have to do it. And to me, for that stopped me taking a lot of stupid trades, because like this here, you haven't got a narrative. For me, bro, it just looks like you're just trying to take everything you see. What you need to do is develop, the first thing you want to do is develop a narrative, right? What's the first thing Lex Waves always says? What's your narrative, right? What's your narrative? Are you looking, what is your overall narrative? Instead of just trying to get every sell and ping pong the market, fuck that. Just try, like, look for, okay, what's the narrative? What's the intention? What's my setup? Okay, do I have an agenda of price? Okay, let's say I'm looking at the market. Let's say I've got an agenda of the market to go lower. All right, cool. Let me okay, find the higher time frame supply zone. Let me set my alerts in my higher time frame supply zone, and let me be patient. Let me wait for price to come into it. Let's say you see something like this, price downtrending. You set a supply zone here. Cool. Set an alert there and just wait. That's it. Just wait for it to come up. Instead of going down to the M1 and trying to hunt trades, be a fisherman and let the market come back to you. Because this, right, like for me, yeah, like if I'm taking a trade, yeah, I'm not going to be buying, selling. Like for me, that's too mentally exhausting. Because you got to understand, when you're on the lower time frames and you're scalping, you will naturally take a lot more losses as well, because the frequency of your trades. I don't like to expose my portfolio unless I see a very good opportunity that meets that's in that higher time frame supply zone. Because think of it like this, yeah. I want to have backing behind me. I want to have support behind me. You know, think of it like in the army, right? In the army, you know, you're not just going to get Rambo, one man who goes into fucking like let's say there's a massive war going on. Like, you're not going to get one person who just goes in and just sorts out everything out. No, you need the whole army behind you. So same thing in trading, right? I'm not just going to enter orders of M1, M2, M3 unless I've got my higher time frame narrative with me. So for me, and the way I've developed my trading plan, bro, and I think this might help you, is to get your higher time frame narrative first, and then stick to that higher time frame narrative. Because if you're looking at this now, of course you've got a lower time frame narrative, but it looks very different, because if you've got a buy marked up, a sell marked up, and you know what I'm saying, it's a bit confusing. You want to get that narrative, and then okay, am I looking to buy? Am I looking to sell? Cool. If I'm looking to sell in the institutional candle, and let's say it hits you, stops you out for whatever reason, now you can look and figure out why your narrative was wrong, instead of just trying to identify every and any institutional candle. It's quality over quantity. And I feel like that is probably one of the biggest things that will help you, bro, is realizing that you don't need to be in every trade. Like, if you've got that quote unquote itch to trade, just paper trade. Don't execute it. Don't execute it. Right. I'll do a lot of paper trading. Right. I'll do a lot of paper trading. So don't feel bad. Obviously, I don't publicize paper trades. I'm only going to show trades I've actually taken. But when you're paper trading, keep your trades to yourself and just let and learn from them. You know, you got no one. Remember, you've got like nothing to prove to anyone. So biggest thing I would say, bro, with this, get a higher time frame narrative and stick with it, instead of looking for buy sells, and base everything on the slightly higher time frames. You'll find yourself losing a lot less trades and being a bit more calm and collective when you've got that higher time frame alignment. Because see, with that ACAD trade, I told you I took one loss on there, but because I had my higher time frame, it didn't mean my whole setup was invalid. It was just UTAD, and I created my if-then scenario, right? When I took my first sell, I got clapped, a BE. Where was it? It was here. Yeah, it was here, off that there. And I think we got the lower time frame, I think like little 5-second distro as well in there, or some shit.
Thing is, even on that Euro JBP, in fact, the structure higher time frame was bearish the day before. So that was for the 18th or the 9th. The one I sent was for the 18th. So the day before it, on the 17th, it was actually, we had a bearish day, and I was looking to trade the bearish continuation. So yeah, it's right there. See where you have that marked up? That was the previous day, the 17th. And I tried to trade the continuation the day after, right there, where you see London the next day. So right around there.
This to go lower.
Yeah, I was looking for that to go lower, and that's where I was entering my trades.
Interesting. So if we were looking at that again, look at the higher time frame narrative. Let's have a look. There, somewhere like that. Have a look. So yeah, for me, daily is bullish on this. Firstly, so it would have been like up equal highs, so potential narrative to go higher. Looking at it now, I mean potential redistribution. So looking at yeah, the M15, yeah. So looking at this as well, the M15 structure was bullish leading up to it. So if you were looking at for shorts in this kind of little distribution area like that, it was just overstanding the fact that these time frames were bullish as well. All right, boom, 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 boom to go higher. So if I was looking at something like that, I would want to see at least, you know, a cleaner breaker structure. Because if we start looking at this M1 down here, yeah, all right. If we start looking at this, this is all internal structure. Look at it from here. This is the low that created that new high. So, but I would want to see that get broken before I engage any shorts.
You don't want to see that lower, the low being broken.
Yeah, I would want to see that low. I'd want to see this dip below this, like this, because again, this is where the demand entered. I wouldn't see that dip below that, and then that would have made me look to buy it. Sorry to sell it to go lower if that was a potential redistro.
Thing is, I thought that I had the 1 hour confirmation, which is a bearish confirmation of the previous day. I was like, okay, the previous day broke structure to the downside. Maybe I can catch a continuation the following day. And
see, I hear you, man. But again, higher time frames, bullish momentum. This is a little accumulation actually. Looking at this now as well, if you want to look at that, there is a little accumulation as well. Potential 4 hour, maybe 4 hour. Okay, hourly. Yeah, so hourly, that's boom, 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 low, create a high, pull back to go higher. So the hourly looks bullish as well. And again, that M1, you're still in that range. So personally, I would want to see it break that range, and to be a bit patient. So for me, I would have just set like an alert like that. So let's say, for example, we thought whatever it was, I'm looking at that, cool. I would have set my low below that, alert there, and then just wait for that to get broken. And then if it gets broken, cool. We can obviously take the trade.
second confluence was that London opened bearish, very, very bearish. So that was another confluence. I also had like a set of things.
Of course, bro. You can have it like there's you can have it like confidence about London opens, but it's realizing that okay, cool. If we're still in a range like that, you don't want to go against the price action. You know what I mean? You want to see that actually break. And if you start looking again like confluence, if you want to look, you've got 15-minute institutional candle like that structure. It's accumulated down here. You know what I'm saying? If we're looking like this, it's accumulated. We're now in the markup phase. So if that markup is going to be invalidated, you need to see it break structure on the lower time frame. So it's just having an extra layer of patience, because again, this was the low that created that high, and cool, maybe it did obviously distribute right on a lower time frame, like a 15-second. But what was the intention to distribute? It was simply just to retrace the slightly higher time frame momentum, and that's why it continued higher, and it turned into a reaccum. So in something like that, like again, like this is where like you can adapt to the market. So if you do get stopped out of a trade like this, you're looking at distro, you can adapt and get into a buy. Because if you're looking at a distro, obviously to sell, and whatever reason you get in for the sell, cool, you're in the trade, and it comes up and breaks and takes you out, it's either going to give you that UTAD or it's going to be a reaccumulation. So it's just about we're looking for, okay, where am I? Am I higher time frames in alignment? What's my narrative? And obviously in this case, it was still in that range. So because it was still in that range, it never, like for me, it never broke anything to get into a sell. So yeah, bro, I would say wait for that low to get taken out, my guy, in the future.
Makes sense. Appreciate you, man. Definitely.
Got you, bro. But like in the future, what you can do if you want to get like re-entries on losing trades, it's just about, okay, if it's, because obviously it's only going to do this, right? So if it goes up and distributes, so you can either do two things, right? It's either going to go up, go sideways and go lower, or it's going to go up, go sideways and go higher, right? So if if it takes you out and goes higher, well, what's it going to do? If it, you know what I mean, it can only go up now. So there's now demand in the market. So it's now it would now be obviously reaccumulation on the lower time frame to go higher. Which is, it looks like it did, bro.
Yeah,
Internal structure.
Very, very sneaky.
Yeah. That's why he's got to be careful, man. Like these lower time frames, bro. You got to be careful of them, man. You got to be careful of them. You got to have that bit more. You got to be a bit more strict and a bit more patient with the lower time frames, bro. I know they can.
Up at London, if you were up that day at London, and say you were looking to analyze it, or even looking for, you had even a bias for it, how would you go? And
I did have a bias for it. I had something marked up on this. So my original bias is to come there to buy it. So I was looking at potential redistribution to sell, and I just never got any. It just never triggered. Nothing. Wasn't anything nice that met my eye, to be honest, bro. You know what I'm saying? There was like, I didn't see anything that wanted me to warrant a trade, to be honest, bro. I didn't really see that. I didn't think it was clean. Again, like if I was gonna, I did have this little area marked up, but again, I didn't get that break below that low. I wanted to see it break below that low first and then go higher. Sorry, break below first and then retrace to go higher and then go lower. But obviously we didn't. So that was why I didn't take that.
one last question before I go ahead and leave it to you, bro. So sometimes, especially around, London times where we find, let's say, a bias for that day, talking about, scalping and day trading. Sometimes we have, a consolidation throughout Asian session, just like we have here, on the previous day. Yep, that one right there. Consolidation throughout Asian session. And then in London, so two things can happen. We can have a bullish break of structure, a bullish leg, and then we can just catch a continuation from that retracement. Sometimes we have a bullish break of structure, and then we have right after it a bearish break of structure too. So we broke Asian from the upside and from the downside. And I find that I saw that a couple of times this week, and that made me a bit confused. So my question to you is, how would you approach that, or would you just change the chart?
I got you. So that whole concept of Asian, get that, take it, put it in your hands, fire out the window. Like, just keep it simple, bro. Like, keep it so simple, bro. Take it back to basics. Market structure, institutional candles, liquidity and imbalance. That's literally it. And obviously Wyckoff. Like, start doing this. Instead of waking up to trade London to look for trades, mark up your charts before, and then set your alerts. And then if they come into fruition in London, then take the trade. Like, instead of, like, you know what I mean? Don't just wake up and just stare at the chart to find the trade, because now you're hunting. Now you're trying to chase the market. And if you're chasing something, it's running away from you. So what I do, and this has given me a massive boost in my accuracy rate, is night before analyzing, setting alerts, and then seeing the next day if it's coming to fruition or not. If it's not coming to fruition in that time, if it's not there, it's not there. You don't always need to be in a trade. So
it's kind of what Mauricio's New York strategy.
I'm not familiar with that, to be honest, broski. Yeah, I'm not familiar with that. Like, the biggest thing I would say, bro, is like whatever type of strategy you're doing, like if you're day trading, if you're swing trading, because again, like I'm coming from a bit more of a swing perspective. So if you want to be day trading, and obviously get for this continuation, the day trade, look on the slightly higher time frames. Starboy's got a really good recorded session on catching New York continuations if you want that. But to be honest, bro, don't come to the market like this. Because remember what you just said. You were saying, sometimes the Asian range does this, that. Fuck, bro, get all that out your mind. Take all preconceived notions and get out your mind. The market's speaking to you. The question is, are you listening? The problem with what you're experiencing, bro, is that you're probably trying to impose your will in the market. And don't get me wrong, right? And that's the thing. Sometimes in trading, we can get so overconfident that we've seen certain things happen over and over and over again. We need to realize that we shouldn't impose our will in the market. We simply just need to see what the market's doing and then respond and then create those if-then scenarios based on what we see. If we're seeing certain things, right? If we're seeing, like, let's say, for example, you perceive this as, a 15-minute break structure. Obviously, it was to retrace the hourly, but if you're seeing this, whatever break of structure to the downside, and you've got an if-then scenario that you want to sell, you've got to have those specific if-then scenarios. Okay, cool. If I'm looking at this supply zone, whatever potential supply, I want to see it come up and break structure out of it and then get in. If I get that, then I'll get in the trade. And it's just having that slightly less, not being as attached to the market, not being So, oh, I want to get in trades all the time. Of course, you can have that eagerness to trade, but sometimes you just got to sit on your hands, man. Like sometimes you just got to sit on your hands, bro. Instead of, because, bro, like that's the thing with these markets, yeah. You don't trade the market, you trade your belief system, and you're gonna project so many different things on the market, bro. Like we could, bro, we could go, like, look, we can literally go on the fucking 1 second right now and find an entry and find a reason to enter the market. You know, oh, maybe the 5 second, but maybe you know what I mean. Oh, what? Where'd it go? But you see what I'm saying, right? We can find reasons and to justify entering the market at any point and reason. Like, oh, look, random institutional candle. Oh, you know what I mean? Oh, supply zone. Like we can do it all day long, but there's a difference between trying to force setups and trying to catch every single crumb in the market and having that abundant mentality to step away from the market and let the market kind of do what it needs to, and then create those if then scenarios based. It's like chess, right? Literally play it like chess. It can only make so many moves. Analyze the market based on what it's telling you. So you're analyzing, interpret the data instead of trying to impose your will on the market. Let the market show you what it's doing, and then based off what the market is showing you and the data you've got, if you think it looks nice and it's meeting your criteria, now you create your if then scenario to engage. If it comes to this level, then I'll take the trade. If it doesn't come to your level, doesn't matter. That's happened so many times. I've got a level in GBP USD I was waiting for. Like these levels here, like absolute monsters, never happened. So it's about realizing that, okay, like it, you know what I mean? It's about just having that patience, man. And instead of like trying to get every single move in the market, just creating those scenarios and letting price come to you and do what it wants. Every session open at continuations. I don't look at that, Janelle. I think I don't know if I pronounced your name right. I hope I did. But I don't look at it like, oh, what happens at a session open happens at a session open. I don't come to the market with, oh, you're gonna get this, that, and the other. You know what I mean? I just see what there is. Like, I mean, typically New York, you might get continuations, but end of the day, you don't want to go with that mentality. You don't want to go into the market with a preconceived notion of what it can do, because the market's not picture perfect, right? You need to go into the market of the mentality of, okay, the market's speaking to me. Am I listening? The market's speaking to me. Am I listening? Sometimes you just got to step back a little bit, take 2 steps back so you can take 5 steps forward, right? Get back, breathe, let the market show you what it wants to do. You know what I'm saying? Like, again, demand, wait for that to get broke if you want to sell it or whatever. But yeah, family, we're going to have to call it a day there. So guys, if you did get value, make sure, obviously, if you got some value from this call, let me get a 777 in the chat. If you got some value from this call, we've been here for an hour and a half and we've been on some sauce. Yo, someone said, can you do it? I can't right now. I've literally got to go, unfortunately. But guys, if you do obviously want to learn more about these, go back to the person who sent you this link, and obviously we'll give you a bit more information on how to get started. Of course, I've got some case studies on my YouTube channel as well. If you do want to go check those out, and we're live on YouTube right now. But anyway, family, oh my God, I didn't even see the people in the YouTube. Sorry, YouTube, I forgot I was there. Yeah, we do. So if anyone wants to know about the signals or the course, more so a course, then send me a DM privately on Instagram. And yeah, I got you, brother. But with that being said, guys, I'll see you all at the top, from the top, because the bottom is way too crowded, man. Let's get it. Sheesh. Oh, why is the meeting not ending? What is this? There we go.